Have you ever wondered what's the difference between the pre-money and post-money valuation of a startup? Let's take a look. Pre-money and post-money are both valuation measures of a company. Both of these are crucial terms in determining how much a company is actually worth. The difference between the two essentially is that of timing, that is before funding or after funding. The pre-money valuation doesn't include the external funding or the latest round of capital injection in the company, while the post-money valuation does. So let's take a look at the difference between the two. Pre-money valuation refers to the value of the company without any external funding or before receiving the latest round of funding. It can be best described as how much a startup might be worth before it begins to receive any investment into the company. Whereas the post-money valuation refers to the value of the company after it raises the funding. After it raises the funding, that is, it receives the investor money. It includes outside financing or the latest capital injection into the business. So why pre-money versus post-money matters? Suppose an investor is looking to invest in a tech startup. Both the investor and the entrepreneur agree that the company is worth $1 million and the investor will put in an additional $250,000 in the company. Now, the ownership percentage for both will depend on whether this valuation is pre-money or post-money. If the $1 million valuation is pre-money, that means the company is already valued at $1 million before the investment, and after the additional $250,000 investment, it will be worth $1.25 million. In this case, the investor will own 20% shares of the company, while the entrepreneur will get to keep the remaining 80%. If the $1 million valuation was post money, that is including the investor's $250,000, the investor in that case will get to own 25% shares of the company, while the entrepreneur will keep the remaining 75%. So as you saw, the valuation method used affects the ownership percentages of both investor and the entrepreneur in a big way. These percentage changes might seem small in the beginning, but it ends up representing millions of dollars of difference if and when the company goes public with an IPO. However, it's very hard to determine what a company is actually worth in the startup phase, as the value of the company is essentially the present value of the future cash flows of the company, obviously discounted at an appropriate discount rate, and the success of the company will depend on so many variables that no human can predict its future accurately. So the valuation is subjective at the early stage of the company and is reached by negotiation between the entrepreneur and the investor. If both of them end up valuing the company at $1 million, it will be worth more if the valuation is pre-money, and the entrepreneur will get to keep the larger portion of the company than compared to if that $1 million valuation is post-money. So how is the post-money valuation calculated? So it's very easy to determine the post-money valuation. Post-money valuation is equal to the investment dollar amount divided by the percent of the company that the investor receives. So if an investor receives 10% of the company for an investment of $5 million, the post-money valuation would be 5 million divided by 10%, which is 50 million. So 10% is 10 by 100. So it will be 5 by 10 by 100. 100 will come on the top. 10 will divide 100 into 10. So 5 into 10 is $50 million. This is after the $5 million have been added to the company's balance sheet. Pre-money valuation calculation. How is the pre-money valuation calculated? So pre-money valuation is generally calculated after calculating the post-money valuation by subtracting the investor's invested money from it. So using our previous example, the pre-money valuation of that tech startup would be $45 million. This is by subtracting this $5 million from the $50 million, and that will give us $45 million. This figure gives the investor a picture of what the company is worth today before receiving any funds. The pre-money valuation is also used to calculate its per share value of the company. Per share value is pre-money valuation divided by total number of shares outstanding for the company. So if a company gets a pre-money valuation of $1 million, and let's say it has a million shares outstanding, that means it has a value of $1 per share. Now if someone invests additional $250,000 in it and buys an additional 250,000 shares, then the total outstanding shares of the company would raise to 1.25 million shares, with each share's worth still being $1. This is per share value. So, if you only wanted to understand the difference between the pre-money and post-money, this is it. You can stop the video here. From this point on, there are some more detail discussed regarding the uses and limitations of these measures. So please continue if you would like to hear those as well. Just in case you are curious, this is Bombay Stock Exchange. This is situated in Mumbai now. Bombay was its earlier name. So first is the users of pre-money valuation. This is from the Investopedia website. There would obviously be some overlap among the users of pre-money and post-money valuations. Often, founders and investors will use both these terms to get an overall understanding of the business and its valuation. But there are some users who might be more interested in one figure more than the other. So according to this site, users interested in pre-money valuations are mostly startup advisors, venture capital firms, lawyers, and legal teams, people like those. So let's look into this. Let's read this. So startup advisors work closely with startups to set reasonable pre-money valuations that attract investors without overpricing the business. They take into account the company's performance, market trends, and growth projections. So advisors basically advise the founders of the company uh, on how to price their business considering various factors. Venture capital firms often invest in startups at various stages of growth. They use pre-money valuation to assess how much of the company they will own before their investment alters the overall value. So when they invest, they will give a certain amount of money to the company, uh, and then the financial situation of the company would be very different. So the value would be different, but they want to figure out how good the company is before they put in any investment. So that's why they are interested in pre-money valuation. This valuation also helps them compare companies within their existing portfolio, determining whether the potential returns justifies the risk of their investment. Okay, right. And then third is lawyers and legal teams use pre-money valuations to draft investment contracts and structure deals appropriately. By knowing the pre-investment value of a company, they can ensure that the equity distribution and terms are fair and provides protection for both the founders and the investors. So it's mostly startup advisors and lawyers, people who are advising or acting on behalf of the founders. They want to know the present value of the company, that is the pre-money valuation. And obviously venture capital firms wants to know what is the value of the company before they move in with any investment. So next is post-money valuation users. So here we have board of directors, private equity firms, employees, and financial analysts. A board of directors monitors post-money valuation to track the financial health and growth of the company after each funding round. It informs their decision on whether additional capital should be raised or if the company is on track to meet its strategic goals. Okay. Private equity firms use post-money valuations to determine how much equity they hold in a company after they have made their investment. Okay, so figure out their percentage It helps them assess whether the company is growing according to plan and prepares them for future fundraising rounds or potential exits. Employees, especially those with stock options, use post money valuation to see how much the company is worth after raising funds. It directly impacts the value of their stock options or shares. Financial analysts use post money valuations to track a company's growth after it receives additional capital. So basically, everyone is tracking the performance. It helps them evaluate how much the company's value has increased due to new investment while looking for insights into the company's future growth potential. So basically, it is used by everyone who is interested in tracking the company's financial performance metrics compared to its latest valuation, compared to its latest post money valuation. Those be board of directors, private equity firms, employees, and financial analysts. Everyone who wants to track the So basically, everyone who wants to track the value of the company compared to the price of the share. Next, let's see some limitations of the two, that is pre-money and post-money. First, we have the limitations of pre-money. These are subjectivity of valuation. Valuation is always subjective. Limited financial data. Yeah, at the early stage, there aren't much financial data available for a company for early stage startups. Dilution, misunderstanding, and challenges in comparing startups. So let's read this. Subjectivity of valuation. Pre-money valuations are often subjective and can vary widely depending on the methods used and who is calculating them. Factors like the company's potential, market conditions, and founder's reputation can skew the valuation. Valuation is always subjective at any stage, but at the early stage, it is more subjective because there isn't any financial data available, and that is the second point here, limited financial data. Especially in early stage startups, there may be limited financial data available to support an accurate pre money valuation. Young companies often lack historical performance records or steady cash flow, making it challenging to assess their value. So basically, it's all imagination. A startup investor has to imagine, based on his own knowledge and wisdom and expertise, that how much potential is there in that company based on all of the factors, the market conditions, but also the founders, the product that company is selling or the service that company is selling, and what kind of mode that company has. Based on all of these factors, the investor has to figure out how much cash that company can generate in the future, and then according to that, what should be the value of the company. Third point here is dilution misunderstanding. Pre-money valuation doesn't account for the dilution that will occur after new capital is added, which can be misleading for founders or early investors. But I don't understand how is this pre-money versus post-money. Like, not that pre-money and post-money are related, they are two sides of the same coin. So that subjectivity of valuation remains there for post-money as well. The limited financial data is there for post-money valuation as well. It's not like company will suddenly start uh, throwing cash in their bank account all of a sudden. Pre-money valuation doesn't account for the dilution that will occur after new capital is added, which can be misleading for founders or early investors. Many stakeholders may focus solely on pre-money valuation without fully grasping how their ownership percentages will be impacted post-investment. I don't think this is such a fair point. Like we calculated the pre-money and post-money valuation earlier in the video, I think the real issue with dilution would be you don't know how much capital you need to raise in the future in the early stages of startup. You don't know the competition that is going to come in, you don't know your customers, you don't know your suppliers, and how much cash are you going to need to go from the early startup stage to a growth phase of a settled company. And for that, there is misunderstanding of dilution. But Once again, it's not pre-money versus post-money. I don't see the difference here. If you guys see, then let me know in the comments. Challenges in comparing startup. It's difficult to compare pre-money valuation across different startups, obviously, especially when they operate in different industries or markets. Each startup may use unique metrics or have different growth potential, making it hard to create a standard valuation framework. So I remember when in early 2000s, when the IT boom was going on, all of these IT companies were raising funds based on their page views. That was the metrics, how much page views they are getting, even though they may not be generating any revenue. So you cannot compare that page view for a website or an app uh, to a manufacturing company or startup in a space sector startup. You cannot compare the two. Now let's move on to the limitations of post money valuations. It ignores operational performance. Post money valuation primarily reflects the company's worth after receiving new capital but doesn't account for its actual operational performance or profitability. It's driven by how much money was raised rather than how well the business is doing. Exactly my point. So you can compare this ignores operational performance to the subjectivity of valuation and limited financial data. So it's not pre-money versus post-money. We just don't have financial data for an early stage startup based on which you can find its value. Ownership dilution can be misleading. Post-money valuation doesn't communicate the impact of ownership dilution for existing shareholders. While the company's overall value increases, early investors and founders may see their ownership stake shrink significantly. Yes, but then their value goes up. They have lesser percentage of the company, but the value is higher. And how is this point any different from this dilution misunderstanding under pre-money? So I was right. Pre-money and post-money has nothing to do with this dilution thing. You dilute your share in the company to raise capital. Company will use that capital to grow its revenue and its profit. So basically grow its top line and bottom line. And because of that, its share value will grow in the future. Your limited shares will be worth a lot more than if you keep the 100% of the company without raising any capital. Doesn't account for investor preferences. Post money valuation ignores most important terms like liquidation preferences, convertible notes, or other investor rights that can affect the true economic values of. I think they have just written some points here. It doesn't I don't see the difference between post money and pre money in these two limitations. Obviously, when you raise capital, you are going to dilute your share in the company, and from an investor's point of view, there isn't enough financial or performance data available to base your value on. So valuation is subjective and it's imaginative, may inflate future valuations. A high post money valuation can set unrealistic expectations for future funding rounds. Investor in later stages may be unwilling to offer the same or higher valuations if the company doesn't show corresponding growth. But that is the risk you are taking as an early stage investor. In the bull run, in a market where the Fed in US is freely printing money like there's no tomorrow, and the interest rates were historically low, almost near zero, all of these companies, whether they are investors or operating companies, they were getting debt for nothing, for free, essentially free. Essentially, they were getting paid for taking debt. If you take, if you raise $1 billion or let's say $50 million of debt from a bank at an interest rate of 1% for 10 years, and in 10 years, if you can double your money, or sorry, in 10 years, if you can make 10 times of that 50 million, that is 500 million, and you pay 1% interest for every year, 1% or 2%, that is essentially free money for you. Now let's see a real world example of pre-money and post-money valuations. This is a lot more useful than compared to limitations, I guess. In 2017, Airbnb underwent a Series F funding round. Before the investment, Airbnb's pre-money valuation stood at $29.3 billion. This valuation represented the company's worth based on its financial performance, growth prospects, and market perception at the time. The pre-money, this was in 2017, the pre-money figure was crucial for investors as it set a baseline value for what they believed the company was worth before any new capital entered the business. This pre-money figure was crucial for investors as it set a baseline value, so it's the minimum value. So this 29.3 billion became the baseline or the minimum value for what the investors involved in Series F funding believed the company was worth before they put in new capital. During the Series F round, Airbnb raised $1 billion in new capital. This injection of cash came from various institutional investors looking to capitalize on Airbnb's rapid growth and its disruption of the hospitality industry. For Airbnb, this $1 billion allowed them to fund new initiatives, expand their platform, and strengthen their market presence as they approach an eventual public offering, so an IPO. Okay. After receiving the $1 billion investment, Airbnb's post-money valuation rose to $30.3 billion. So if you add $1 billion to this 29.3, it becomes $30.3 billion. The post-money valuation is calculated by adding the new capital raise, that is $1 billion, to the pre-money valuation. Investors who participated in the round now had a clear understanding of their stake in Airbnb, as their 1 billion represented about 3.3% of the post-money valuation. Okay, alright, so Airbnb was assumed to have a pre-money valuation of 29.3 billion. Based on that, its per share value would have been calculated, and the new investors put in an additional 1 billion at that per share value. So whatever the per share value would have been, that would divide by 1 billion divided by that per share value will give you new number of shares that they added to the company's account, and then in the end their total percentage, that is 1 billion divided by 30.3 billion, was 3.3% of the company. Alright, so basically, like I said, pre-money and post-money are two sides of the same coin. One is before getting the funds and the other is after getting the funds. Can you guess which city is this? Try to look for the iconic buildings here. How about this one? This should be easy. And this one. Let me know in the comments and I will give a heart to the right ones. So let's end this with some key takeaways. Pre-money and post-money are both ways of valuing a company, that is, ways of determining the worth of the company. The difference between them essentially is just the timing of the valuation. Pre-money is the valuation of the company before it receives any outside investment. Post-money is what the company is worth after it receives the outside investment. And when discussing the valuation of a company, it is important to specify which type of valuation it is to give an accurate picture of the company's financial situation and its ownership division. So that's all for this video. Thanks for watching, and until next time, see ya.